In today's video, I want to delve into how an AMC dividend and share recall could expose synthetic shares. And to illustrate this, we have a perfect case in CRGP, which recently unveiled over 300 million synthetic shares. Hey, welcome to AMC Daily. If you are new to the channel, be sure to subscribe to the channel and turn on post notifications by hitting the bell so you never miss any of our uploads and also enter our giveaway. But everyone remember, this is not a financial advice video. 100 miles an hour took to Twitter to ensure everyone comprehends the gravity of the situation. He stated that a federal court case had pinpointed counterfeit stock from unregistered brokers. The judge acknowledged the need for a thorough review and implied that another case might be necessary to resolve the issue. In other words, a full-blown lawsuit was in the works. But let's break it down into simple terms to grasp exactly how this synthetic exposure unfolded. CRGP initially had a total of approximately 126 million shares. They declared an interim dividend of $0.11 per share. Shortly after announcing the dividend, they made an announcement to issue 300 million new shares, or more precisely, 327 million. The new share issue was set to occur after the dividend payment, and therefore, the dividend shouldn't be applied to these new 300 million shares. The dividend declaration came first, so it should only be paid on the original 126 million shares, not the new 300 million. Simultaneously, CRGP had suspicions that something was amiss. As they issued 300 million new shares, they also bought back 300 million shares. In theory, this shouldn't have posed a problem. You have the original shares, the new non-dividend eligible shares, and the shares being bought back, which could simply match up. But the DTCC, the Depository Trust and Clearing Corporation, couldn't distinguish between real, fake, old, new, or any other type of shares. They erroneously deducted the full dividend from 426 million shares from a single broker, Core Clearing LLC. Core Clearing LLC contacted the DTCC, pointing out the error and requesting assistance to rectify the situation, as it had taken a substantial amount of money from their accounts. Unfortunately, the DTCC claimed they couldn't identify any issues and advised Core Clearing LLC to solve the problem themselves. As a result, Core Clearing LLC attempted to sue CRGP along with several trading platforms and brokers. These numbers are somewhat simplified, and there's more complexity to the lawsuit than outlined here. But the main point is that the DTCC couldn't differentiate between real and synthetic shares. Consequently, they deducted the full dividend amount from all shares outstanding, even the new issue that shouldn't have received a dividend from a single broker. This led to FINRA imposing a U3 trading halt on CRGP, much like they did with MMTLP. The lawsuit is a captivating read, shedding light on how a seemingly straightforward dividend and share buyback exposed synthetic shares. This is precisely why Pip and Sammy advocates for Adam Aron and AMC to issue a cash dividend. The rationale behind this is that even a small dividend would expose every counterfeit share, since the DTCC would be unable to distinguish real from synthetic shares and would end up paying dividends on all shares. Consequently, every shareholder would receive a dividend. However, this could cost brokers and trading platforms hundreds of millions, if not billions of dollars. The question is whether these brokers and platforms will have to pay the dividend on all outstanding shares or liquidate the synthetic shorts quickly. The outcome would depend on the dividend's value and the extent of synthetic shares in circulation. It's possible that these brokers could face billions of dollars in costs. It's worth noting that the Robinhood margin call back in January 2021 amounted to just over $3 billion, and a small cash dividend could potentially trigger a similar event. Moreover, Michael Gade's tweet suggests that we are on the brink of a significant shift in Treasury's behavior during a market collapse. He predicts that the mother of all short squeezes is imminent. As I mentioned in a previous video, it will be intriguing to see how politicians react to a plunging stock market. Many of these politicians have substantial investments, not only in bank stocks, but also in stocks across the S&P 500. They have a vested interest in safeguarding their net worth. Consequently, we might see a comprehensive market-wide shorting ban to protect politicians' financial interests. Already, measures are being taken to avert a market collapse. Finance Lancelot's tweet highlights some unusual developments at CBOE. He points out that certain products have failed to deliver for 5 consecutive days and are now on the threshold securities list. These products primarily include VX ETFs and VX-related products. This suggests that someone is currently shorting the VX with synthetic shares or generating synthetic VX ETF shares. It's important to remember that the VIX is a volatility index, and as it rises, the market becomes more volatile and likely to crash. By shorting the VIX and preventing it from surging, someone is effectively stalling a market crash. It's evident that they are doing this with a large number of synthetic shares, as multiple VIX ETFs and VIX products have made it to the regulation ASTRO threshold securities list, indicating a significant shortage and failure to locate and deliver these VIX ETF shares. Adding another layer to the intrigue, the on-balance volume, OBV, for AMC has reached an all-time high. AMC's OBV surged in January and June of 2021. Since then, it hasn't declined, indicating that retail investors are holding onto their shares. Over the last 2 years, particularly in the past month or two, the OBV for AMC has seen remarkable growth. This coincides with a net balance between long and short volume, showing a positive 1.49 billion shares, meaning that 1.49 billion more shares have been purchased than sold. This suggests a significant increase in the issuance of synthetic shares, especially over the past couple of months, in line with AMC's surging trading volume. More AMC shares have been traded in the last 2 months than in the 2 years following June 2021. In response to these developments, the mainstream media has resorted to spreading more FUD, fear, uncertainty, doubt, to downplay AMC's success. They are attributing a potential post-pandemic outbreak in 2023 to activities like indoor gatherings, watching Barbie, Oppenheimer, and Taylor Swift. They're insinuating that AMC, Taylor Swift, Barbie, and Oppenheimer are to blame for a supposed pandemic resurgence. This is nothing more than another attempt by the mainstream media to undermine AMC's performance. In conclusion, the unfolding situation with CRGP and other events in the market highlight the vulnerability of synthetic shares and the potential impact of a cash dividend. The market is showing signs of increasing instability, and the mainstream media is doing its part to cast doubt on AMC's success. As we move forward, it will be essential to keep a close eye on these developments and their implications for the financial markets. Guys, that's all we have for you today. What is your opinion about AMC stock? Get involved and let us know in the comments down below. Thank you for watching.